In the next 24 hours, traditional finance will move billions of dollars, charge fees, and take days to settle. In that same time, a parallel financial system, running on pure code, will move billions instantly, with almost no human intervention. This is decentralized finance, or DeFi. And right now, in 2026, it's at a tipping point, poised to either build the foundation for a new global economy or collapse under the weight of its own ambition. Market forecasts for DeFi are all over the map, with some credible projections seeing it grow into a market worth hundreds of billions by 2031. But this isn't a simple growth story. For every $1 billion pouring in from the world's biggest financial institutions, another headline warns of a catastrophic hack. We are at a crossroads. The giants of traditional finance are going all in, betting this technology will modernize everything from bonds to banking. But a few critical flaws could bring the entire system crashing down. So, the question for 2026 is no longer if DeFi can work, but whether it can be made safe enough to handle the world's money. Is this the next trillion-dollar bet, or a trillion-dollar house of cards? The case for DeFi's explosive growth isn't just hype from crypto enthusiasts anymore. It's being written in the boardrooms of the world's largest asset managers. And it's not just about people trading cryptocurrencies. This is about a fundamental rewiring of finance itself. So, what's lighting the fuse? In a word, institutions. For years, big money sat on the sidelines, intrigued by the tech, but terrified of the risk. That's changing, and fast. In 2026, global banks and asset managers aren't just experimenting. They're actively integrating DeFi infrastructure because it offers transparent settlement, programmable products, and dramatically lower costs. The main vehicle for this institutional rush is real-world asset tokenization, or RWA. The concept is simple. Take a traditional asset, a government bond, a piece of real estate, a slice of a private credit fund, and issue a digital token representing ownership on a blockchain. Suddenly, a clunky, illiquid asset can be traded globally, 24/7, and settled in an instant. This isn't a futuristic dream, it's happening right now. BlackRock's Tokenized Treasury Fund, BUIDL, has seen explosive growth, quickly surpassing $1.7 billion in assets under management. Franklin Templeton's own Tokenized Money Market Fund is another major player that has reached significant scale, and it was the first US-registered mutual fund to use a public blockchain as its official system of record. When the world's largest asset managers are scaling regulated products to billions on public blockchains, the narrative shifts from speculation to infrastructure. This tokenization of real-world assets is becoming a dominant use case, with some aggressive forecasts projecting growth rates of over 50%. Projections for the total size of the tokenized asset market vary wildly, from a conservative $2 trillion to astronomical figures in the tens of trillions, depending on what's being measured. But the direction is clear. Institutions are here, they are building, and they are creating everything from on-chain bank loans to hybrid RWA pools. This institutional wave is supported by other strong fundamentals. Lending protocols in DeFi are booming again, with the total value locked across the ecosystem recovering to levels approaching $100 billion. Leading platforms like Aave are introducing architecture designed specifically for institutional scale. The convergence is undeniable. DeFi is evolving from a niche, experimental playground into what some now call on-chain finance, a professional-grade system poised to become the backbone of tomorrow's capital markets. The bull case is simple. The efficiency, transparency, and accessibility of DeFi are too powerful for the old world of finance to ignore. But for every $1 billion of institutional capital flowing into DeFi, there's a dark cloud of risk that threatens to wash it all away. The system's greatest strength, its reliance on automated, unstoppable code, is also its most terrifying weakness. And in 2026, the threats are more potent than ever. The most visceral risk is security. Hacks aren't an anomaly in DeFi, they're a constant, brutal reality. April 2026 was one of the worst months in DeFi's history, with over $630 million stolen in more than a dozen separate attacks. Two exploits alone on KelpDAO and Drift Protocol accounted for over $500 million in losses. By the end of May 2026, cumulative losses from hacks for the year had already blown past $840 million. What's truly frightening is how these attacks are evolving. It's not just about finding a bug in a smart contract anymore. Attackers are now targeting the very infrastructure holding DeFi together, the cross-chain bridges, the data feeds known as oracles, and even the governance systems meant to protect protocols. In one major hack, attackers compromised the infrastructure feeding data to the protocol, essentially tricking it into releasing nearly $300 million. This is like robbing a bank by convincing the vault it's empty. This highlights the second major risk, contagion. DeFi protocols are often called money Legos, where different applications snap together to create new financial products. But this also means that if one Lego brick is faulty, the entire structure can collapse. A vulnerability in one protocol can cascade across others, setting off a domino effect of liquidations and losses. We've seen this happen when attackers use compromised assets from one platform as collateral to borrow clean funds from another, spreading bad debt across the system. Unlike traditional finance, there's no central authority to halt trading or a government to bail out a failing firm. It's a bank run at the speed of light. And then there's the regulatory hammer. For years, DeFi operated in a gray area, with many projects claiming decentralization put them outside the reach of regulators. That era is definitively over. In 2026, regulators worldwide are moving from watching to enforcing. The European Union's MiCA framework is now largely in force, with final transitional periods ending. This requires crypto asset service providers to get authorized or shut down. In the United States, regulators have made it clear that decentralization isn't a free pass. The core conflict remains: the privacy valued by crypto users versus the transparency demanded by global anti-money laundering rules. This patchwork of global rules presents a massive operational risk. A protocol could find its liquidity crippled overnight if a centralized stablecoin issuer freezes assets on its platform to comply with sanctions. Issues like network congestion, high transaction fees during peak times, and the sheer complexity for an average user are still major barriers. The dream of a frictionless financial system is still just a dream as long as these fundamental risks persist. The bear case argues that until DeFi can solve for security, contagion, and regulation, it will never be more than a high-stakes, digital Wild West. So you've heard the bull case for a trillion-dollar revolution and the bear case for a catastrophic collapse. This is one of the most complex and important financial stories of our time, and we're going to be tracking every development. If you want to stay ahead of the next financial revolution and understand the risks that come with it, make sure you subscribe and hit that notification bell. So where does that leave us in 2026? Is decentralized finance maturing into the core infrastructure of modern markets, or is it still too volatile and dangerous to be trusted at scale? The potential is undeniable. The entry of giants like BlackRock and Franklin Templeton proves the efficiency of on-chain finance is no longer a theoretical benefit. It's a strategic imperative for the biggest players in the world. The promise of tokenizing real-world assets, making markets more accessible, and cutting out the friction is slowly but surely being realized. The conversation has shifted from if to how. Yet, the risks are just as real. The scale and sophistication of hacks are growing, with attackers now exploiting the very governance and infrastructure that underpins the ecosystem. Regulatory frameworks are finally solidifying, but they bring their own challenges, forcing a once anonymous space into the light and demanding a level of compliance many projects are not built to handle. The journey from a multi-billion-dollar market to a multi-trillion-dollar one isn't guaranteed. It depends entirely on whether the industry can solve these fundamental problems. The future of DeFi hinges on building more resilient security, creating fail-safes against contagion, and finding a sustainable balance between decentralization and regulatory compliance. The next $1 trillion in finance won't simply be earned, it will have to be secured, insured, and regulated. The question is whether DeFi can build the vault before the gold rush collapses the mine. The answer will not only determine the fate of this technology, but will also define the future of money as we know it.